Good afternoon, everyone. Robert Reaburn here from Life Pro Asset Management. I hope that everyone's having a fantastic week so far. And as usual, if anyone has any questions, please do not hesitate to reach out to our office, whether that be for specific transactions you need to make, or perhaps you have questions on the market. Certainly after Monday's sell-off, we usually get a few questions inbound, what it means, what it doesn't mean. So definitely feel free to give us a call. My personal cell phone number is 858-354-5114, or you can reach us directly at our offices at 888-543-3776. Now, we recently received news that in California, we will have to be working remotely here for the remainder of the week. But we do want everyone to know that our offices remain open. So anything you need, do not hesitate. We're here, we're working, and so we're more than happy to fulfill any of those requests. But what we wanted to do this week was, we wanted to tackle Monday's sell-off, what it means, what it doesn't mean. Largely a profit-taking event, so if you can't sort of stay with us here for the next few slides, do know that Monday was largely a profit-taking event. In other words, we had a strong 20% move up in the value of our investments over the last 4 to 5 weeks. And whenever you get a move that strong, you know, it's you can't go up every single day, and sometimes it just takes a sort of a hair trigger event to provide that excuse to go ahead and take some profits. So nothing to be too concerned about. In fact, Monday was a very healthy event because what it does is it takes a lot of froth out of the system in the very short term. And when we look at our overall portfolio, we now see a nice reset, a consolidation period, a chance for our individual investments to take a little bit of a rest in the short term before resuming upwards. So we love events like that. It's kind of painful when those days take place, but you need that in order to resume the upward trend. And so it's actually a healthy thing that happened on Monday. Usually, those types of events last between 1 and 3 days. When it's sort of short term like that. So that's all signs at this point to that sort of just healthy reset event. The other thing that we wanted to kind of focus on today was a message that if any of our clients or advisors have spoken with us directly, they'll know that one of the big things that we focus on is the fact that the stock market does not equal the economy. And we came across a great quote this week from Bill Miller, actually a legendary value investor. And one of the things he said was that before you can say that the market is disconnected from reality, it's implied there is some belief or evidence about what the connection is between the market and economic reality. And the answer is very clear. There is no connection whatsoever. Now, what was more interesting was the fact that Bill Miller put some quantitative data behind that assertion. And it's something that we've talked about. For those who listen to us every week, we've talked about this for years, is that the market simply does not equal the economy. And if you go back and look at all of the data, according to Bill Miller, going back from 1930 all the way through 2019, and look at the annual correlation between the markets and economic growth, what is correlation? 1.0 means it's perfectly correlated. If the economy goes up 1 or 2%, the markets go up 1 or 2%. If the economy shrinks 1 or 2%, the markets shrink 1 or 2%. But when we're looking at that correlation between markets and economic growth, the answer is that the correlation coefficient is 0.09. And for those of you who know how to measure correlation, that basically means it's near zero, which means there's no correlation. There is zero exact, there's zero. It is exactly random. And so very, very important as we think about the election season coming up, as we think about the ongoing uncertainty of second wave COVID outbreaks and ongoing COVID outbreaks and what it means for unemployment and all that stuff. The reality is we want to focus on liquidity. We want to focus on cost of capital, access to capital, and the specific businesses we're invested in and what those valuations represent to future returns. Those are the factors that really drive investment value, not the economy. So very important to make that distinction. And you need no evidence, you don't need to look any further than our own investment returns this year to understand that. You know, in 2020, we're going to have a shrinking economy. Does that mean you should not be invested in the market? And our answer is absolutely not. Had you invested with us at the beginning of the year, you'll be up 43.27% versus a decline of 1% for the S&P 500. That really means at the end of the day that we've been able to effectively avoid those areas of the market that are more cyclically driven, more correlated with the economy, and we've been able to focus on those businesses that have long-term secular growth. In other words, they are not correlated to the economy. And that's really important for us as long-term investors. So when we look at since inception, we're up about 133.47% versus 42.82% for the S&P 500, generating outperformance of 90.65% after fees. Now, this 43.27% that we're up in 2020 is an important number because last Wednesday, when we released our performance figures, as of last Wednesday, we were up 44%. So yes, Monday was a kind of a kick to the shins when we had that broad sell-off. But remember, just last week we're at 44%. So really we're just offsetting about 0.8% of gains from last week. We just happened to have a really strong Thursday that we reversed on Monday. So important to take sell-offs into perspective. All Monday did was get us back to, knock us back to mid last week. And so, when we look at our performance numbers, these are, numbers where we are absolutely happy in terms of where the portfolios stand. And what we got to do is make sure that we continue to do that, continue to push the football forward down the field, and continue to get into the end zone for not just our existing clients, but new clients as well. Now, the bigger picture is, and this is something we don't talk about as often, but perhaps we should, is that starting in 2009, it's our belief based on our research, based on our work, that we are in the middle of what we call a secular bull market. Okay, well, what is a secular bull market? A secular bull market tends to last in and around 15 to 20 years, which means sometimes you can have a cyclical bear, another a short-term bear market, but the broader trend is up and to the right. So if we look at really between 1950 and 1968, we had a long-term secular bull market, and then we had a secular bear market. A secular bear market essentially means where stocks go nowhere for a protracted period, such as 10, 12, 14 years. We had that period during the Great Depression, in which that exited after World War II. We had that secular bull. Then, of course, we had the stagnation of the 1970s. For those of you who are around to remember that, it was a slow period of economic growth for the U.S. until we had deregulation and tax cuts and lower interest rates. That defeat of inflation caused a secular bull market from 1981 to 1999. And then, of course, most famously, we had the secular bear market between 2000 and 2010 that was epitomized by the 2008 financial crisis. Out of that, we had the defeat of the financial catastrophe. In other words, we saw the birth of a new secular bull market. And if we look historically speaking, what the bear market in both 2018 and in 2020, because of COVID, represent is a cyclical bear market in the middle of a longer-term secular bull market. In other words, we actually think there might be another 10 more years to this secular bull, which is one of the reasons why we are always very hesitant to take too much risk off the table. So this is, if we look at the average length of a secular bull market, it's about 229 months. The current length of this current secular bull market, which was born in March of 2009 is 86 months. So the cyclical reset event, in this case the March COVID crisis, provides that fuel for further gains because it lowers interest rates, increases liquidity, and increases that money printing by the Federal Reserve, the supply of cheap money that fuels asset prices. That's what we look for, not the economy, but that liquidity, that fuel to continue to push the market higher. Now, for the second half, a little bit shorter term, what are we looking for? We're looking for positive participation in the overall stock market. Are more and more stocks participating in this rally? In other words, is breadth strong or is it contracting? Are fewer and fewer stocks holding the market up? And what we can see here is that as the S&P has risen, breadth has expanded. And just as important is that the overall investor sentiment has declined. And one of the things you want to look for is everyone optimistic? Is everyone exuberant? Or is everyone pessimistic? A secular bull market tends to climb up a wall of worry, a permanent state of despair, which we've sort of been stuck in since 2009, but definitely reaccelerated that despair in 2020 thanks to COVID-19. So what we see is the market's rising, breadth is expanding, more and more companies are participating in the rally, investor sentiment remains mired in pessimism, and most important is that forward earnings estimates have started to bottom. When we look at the stock market, we don't care about 2020. I want everyone to repeat that. We don't care about 2020. It's all about 2021. And when we look at the forward estimates for the S&P 500, they've started to bottom and adjusts just ever so slightly upward. And as that starts to move upward, as we see prospects for a recovery in the second half of 2020, but most importantly 2021, that will be a positive tailwind for the overall market. So strong breadth, weak investor sentiment, a bottoming in overall earnings estimates is a 1-2-3 punch that allows the market to continue climbing up that wall of worry. So ignore the election, please, unless it sort of specifically involves a business related event. And also, please ignore COVID for the time being and focus on 2021. The other big thing is we wanted to focus on Monday. So Monday, as we said, was a profit-taking event. You need these types of days in order to reset stocks so that they can rest, they can relax, just like a sprinter. They can consolidate and then eventually form a base from which to break out higher upward and to the right. That is what we had here. So we, for example, in this particular slide, they refer to DocuSign. We own DocuSign. We love DocuSign. That is one of many companies that we own, both good and bad. But this is one name that has worked that worked in the portfolio that was included in this list of strong reversals on Monday. You need these types of resets in order to allow stocks to move higher. And it's an important point. Where we get concerned is if stocks just go up every single day. Because what that does is it creates an overheated market, and that's what allows bubbles to form. Days like Monday act as a reset, act as sort of from a preliminary standpoint, going in there and popping any sort of early stage bubble before it can become dangerous. So it's very healthy in terms of what happened on Monday. And you can see here, the most overbought stocks led the sell-off on Monday, while the most oversold stocks still were actually relatively weak. So it wasn't the representation of a broad rotation, but more or less taking some profits on those stocks that have worked most year to date. The other thing we would say is, though, longer term, to have a market that's overbought is a sign of conviction, right? It's not a sign of complacency. When we look historically speaking, when the number of stocks above their 50-day moving average is greater than 90%, as it was back in mid-June, the forward 52-week returns in all historical incidences was positive. We can see that here on the column to the right. Every single time that the market had a 50, that all stocks, that the S&P 500, the number of stocks trading above their 90-day, trading above their 50-day moving average was greater than 90%. Every single time that happened, 1 year later, we had not only a positive return, but a strong positive return. And for those of you who've been paying attention, we really do believe that March was similar. March of this year was similar to March of 2009. We had the bear market. We had the federal government respond in force, killing off the recession and ultimately resetting the market for the next stage higher or for the next bull market. And so we really do believe, based on our work, that the groundwork is there, not just for a strong market between March of 2020 and now, but for the next 1, 2, and 3 years and beyond. So if you have not invested, this is the message. If you have not invested yet and you feel like you've missed the rally, the good news is we believe that there's years ahead in terms of this current market rally. The other big thing is we want to look at what is the effect of investor sentiment on returns. So when the percentage of bullish investors is below 30%, as it is right now, what we see is the forward returns are almost always positive 26 weeks out, with the exception of course, here in October of 2019, where we've had the impact of coronavirus. So historically speaking, we got investor sentiment on our side. We have a strong breadth picture as the number of stocks back in June traded above their 52-week moving average, or sorry, their 50-day moving average was above 90%. And of course, we see a strong rotation into long-term growth versus the more defensive areas of the overall market. Combine that with liquidity. Remember last week, this was the money supply picture. When you see that sort of money supply, don't make it more difficult than it needs to be. Hold your nose, buy stocks, buy quality stocks led by good management teams. And long term, you're going to probably make some pretty good money. That's just the historical, that is the historical track record for the overall stock market. Lastly, of course, credit risk continues to decline. So this is one thing we want to watch for. We want to make sure the financial foundation for the overall market remains intact. What we did not see, this is something we look for a lot. What did we not see on Monday? We did not see a widening of credit spreads. We did not see credit risk deterioration. So when we see that sort of picture take place, it tells us that really Monday was a profit-taking event because we did not see credit markets puke. We did not see people take risk off the table in the lending markets. Very important. The fact that this remains near lows is a very important point. So overall, investors continue to hate this bull market, and that's a positive thing. Cheap money is flooding the economy, and we actually think the U.S. consumer is set up for a recovery into the fall, and stock selection remains critical. We want to focus on the areas of the market leading long-term growth. We want to shy away from those areas of secular decline, deterioration, and we want to focus on not only the areas of secular growth, but what are those companies that are leading positive disruptive change? And those are the types of companies that we want to remain focused on. Companies that are going from good to great, not turnaround stories, quite simply the leaders in each of their respective spaces. Go long people, quality management teams with great business models, and long term, your portfolio should benefit. So overall, thank you again for all of your support. The success of our strategies this year and last year and the year before could not be possible with all of the support from our clients and advisors. So thank you very much and have a fantastic week.